โอเค
Okay. So we're to 7. To 7. Option traders. But when we say option traders, we mean option participants. Page 32. You got a lot of option traders. Membership. Every exchange will have members. Members are entities, could be people, could be businesses, could be financial institutions, which own the exchange. And membership is ownership of the exchange. So an exchange may have 25 members. Merrill Lynch and Bank of America, whatever these. Each membership is called a seat. And the seat gives the member the right to trade on the floor of the exchange. On the floor of the exchange. 271. Market maker. Market maker is a market participant who is required to make at any time a bid and an offer. The market maker is required at any point in time to provide bid and an offer. This means if you want to sell, the market maker must buy. If you want to buy, the market maker must sell. Okay? The market maker will have a bid price and an ask price. The bid price is the price that the market maker offers to you to buy your security. The ask price is the price which he offers to sell. So the bid price is to buy, and the ask price is the price to sell. The difference between the bid price and ask price is called, anybody? Spread. Bid, ask, spread. In finance, you have many different types of spreads, hundreds of spreads. So you cannot just say spread. You have to say what kind of spread, okay? When we study risk management, we're going to study at least a few dozen of different spreads, okay? Corporate spread is the difference between the return on corporate bonds and government bonds, okay? So you got a lot of spreads. The prime spread between the prime interest rate and government bonds and so on. Okay. The market maker may use technical analysis. He may use fundamental analysis. The market maker is required to sell. And if the market maker is required to sell, this means that he must own options. If he owns options, this means that he can lose on those options. Sometimes a lot of people may want to sell and he will be forced to buy. So sometimes he'll be forced to buy at a disadvantage or sell when he does not like to. So market maker must trade like any other trader and try to survive and make a profit. The gain of his trading is the bid-ask spread, but he can lose in other ways. The trading styles for any trader, not necessarily the market maker. Trading style, let's write it with red. Involves the main strategy that a trader adopts to minimize risk. What's the risk management strategy? And they could be scalpers. A scalper is a trader who buys and sells quickly, usually within a couple of seconds, up to a few minutes. So a scalper will buy and then try to sell as quickly as possible. Or if he sells, he'll try to buy back as quickly as possible. Usually, the position they take is from a couple of seconds to just a few minutes. Position traders. Position traders usually hold a position from a few minutes, maybe 2, maybe 10, maybe 20 minutes, rarely up to an hour or 2. Okay? They're not going to hold position very long. And if you're an option trader, another type of strategy is called a spreader. And a spreader is someone who initiates a spread, okay? And we're going to study spreading strategies down the road, maybe in chapter 6 or so. A spread will be, let's say, a long with one exercise price, and then a short, the next exercise price, or a nearby exercise price. So the two, the long and the short, almost cancel each other. They minimize the risk. So these are some prominent trading styles. These strategies will be covered in chapter 7. Number 2, floor broker. 272. Let's emphasize, the market maker is a dealer. He trades for his own account, just like any exchange bureau over here. When you go for a currency exchange, they trade for their own account. A floor broker trades for the public. And he executes for the public. He represents the connection between public, meaning you and me, and a member. Okay? So if I want to buy 20 options, I can't buy them from the member. I have to go to the floor broker, and the broker will buy it from the member. Actually, I have to go to my broker, okay? My broker will work with another broker, okay? Another company broker, and that broker will have a floor broker. So from me, it's going to go to my broker. My broker is going to work with the other broker, and that broker will have a floor broker, and the floor broker will buy it from a member. Okay, so that's how it works. So, the floor broker will either get a flat salary or he'll get a commission. Whenever he has to execute between the public and their own, the floor broker is required always to execute first for the public. This is to prevent the public from being cheated. Okay? So, he has to execute whenever there's a public order, the public order first and at the better price, and then he can trade for himself and for his company. Some can do both. Some can do only for the public, and others can do both for the public and for themselves. This is known as dual trading. Dual trading is another name for a company which is known as a broker-dealer. Broker executing for the public, dealer executing for themselves. In general, they're allowed to be broker-dealers only if they provide priority for the public, which they usually don't, but that's a different story on the legality. Number 3. Order book official. This is an official of the exchange who maintains the order book. The order book is a listing of all limit orders. So there'll be buy at no more than 15, buy at no more than 16, buy at no more than 17, or sell no more than 25, no more than 26. I'll get to explain these in a few minutes. So there is a book with all open orders, and he'll maintain that book. And when there is a market order to execute or the price reaches certain limit, he'll automatically execute these. So, he's an official of the exchange who maintains the order book and who makes sure that orders are executed properly, okay, and on time. And here, again, the same rule. Public limit orders are always executed before the private, before those of market makers and market dealers, okay? What's going on, guys? Fun time? Okay. You have other option trading systems. Other option trading system means that there is no one way to organize an exchange. An exchange could be organized in a number of different ways, okay? Could have many market makers on one particular stock. Each could be a market. Or you could have only one market maker of one particular stock. So there are different ways that you can organize an exchange. It is one model of it. Let's see. You may have what's known as a specialist And a specialist is a market maker who specializes in only one particular security. So he's a market maker for one particular security. He is given the exclusive right to make the market for that security, but he's also obligated. He must trade, okay, whenever there are orders, okay? So specialist, it means that the market maker is one for the security. While you may have in other organizations many different market makers for the same security. You may have what's called registered option traders. And registered option traders, again, they buy and sell for themselves, act as dealers, or they can act as brokers. And here's the key, without necessarily being a member, okay? In a membership, you own part of the exchange, okay? And it gives you the right to trade, which is a seat. Here, you're only licensed. You get a license, but the exchange may take your license, okay? Or it may give more licenses, okay? And you also have 275 off-floor traders. In other words, a lot of traders will not trade on the floor of the exchange. Now, I need to define what is a floor. Floor is a place, usually a round place, or it's called has 8 sides, hexagon or octagon, 6 sides or 8 sides, where trading occurs only inside. When you're in or on the floor, you can execute a trade. So, members and other brokers will go or will be inside the floor or approaching the floor. And this is simply the place where trading occurs. This is the place for rice, and this is the place for wheat, and this is the place for corn, and this is the place for gold, okay? So, you want to buy gold, you walk there. You want to buy wheat, you walk there. You want to buy rice, you go here. It's very simple. So we got a place where you meet people. And you got a lot of off-floor traders, which will be somewhere in an office. They'll be watching the screens and they'll be trading. Fairly straightforward. Number 6, 276, membership cost. To become a member could be sometimes expensive. It could cost 2, 5, 10, 20 million US dollars. Membership is, there's a secondary market, could easily be bought or sold. You want to buy a membership? No problem. 15 million will buy you one, okay? US dollars, okay? So you go, you buy one. And then you try to use the membership to, make a profit. And the membership itself is an investment. You buy it for 15 million, hoping every year to make $1 million or 2 out of it. In other words, you hope to make 7, 10, 15%, as much as you can on your initial capital and on your time and skills. Okay? So, membership can cost, and there's a nice little chart over here. You can see how memberships here were small. 2, 3, 4, $500,000, and then suddenly shoot up to $3 million. Okay? So, suddenly, since 2002, option trading has skyrocketed. With it has increased profitability. Thank you. Increased profitability, and with increased profitability, the price of the membership would increase too. And you can, if it membership's capital, you can purchase it and buy it outright, like you buy a house for, let's say, a little condo for 2 million, or you can rent it. You can rent it on a monthly basis for 10,000 baht or on an annual basis. So, membership could be purchased, you pay the full price and you own it, or membership could be rented for a week, month, whatever. Usually, it's rented for a year, but it's a contract between two parties. You can trade it anyway, rent it any way you like. The biggest cost of membership is, translation, stress. You work 16 hours, you're under pressure, you go crazy, you can make mistakes. It's stress. How is stress? Everybody understands stress? So, one of the biggest costs is actually, you watch the movie Wall Street, right? You see, at one point the guy gets in the game. He cannot sleep. Every 2 hours he wakes up to check what's going on the Japanese markets and other things. You lose sleep. You worry. Okay? You can lose $1 million or $2 million in a couple of hours or maybe minutes. Okay? You are a trader, you got a big position, something happens in Japan and boom, you lose a couple of million in a couple of minutes. Okay? These things do happen. So stress is a terrible cost. And in general, part of the stress or the cause of the stress, that it's a high risk profession. This is a risky business. It's very, very risky. All right. I got some drink over here, and we continue with number 8. Oh, this is going to be very quick and easy. Number 8. Mechanics of trading. 2.8. Trading mechanics. Page 36. Let's see what we got. First, you got an order. An order to buy or an order to sell. You can have a day order. This is order valid during the trading day. GTC order. Good till canceled. So, you place an order, GTC, it's good, unlimited until you go and explicitly cancel it. Well, the most common one is called limit order. Limit order gives you the worst possible price. So, let's say want to buy an option, limit price 7. This means you can buy it for 5, you can buy it for 5.30, you can buy it for 6.30, you can buy it for 6.99, you can buy it for 7. But you will not buy for 7.01 or for any higher price. Okay? So the limit order gives you the maximum price that you will pay to buy or the minimum price you pay to sell. Next one is stop loss. Stop loss. If you have a long position, okay, and the price falls below a certain price, you want to sell. This is a risk management tool. So, you got a long position, the price is 7, and you have a stop loss at 5. So, as the price goes up and down, up and down, up and down to 6, maybe 5.5, nothing happens. As soon as the price hits 5, it becomes a market order to sell. And you sell at a price hopefully near or right around 5. It could be a little over 5, could be usually a little less than 5. Okay? So, the stop loss will mean that if the current price is 7, you will not allow to fall below 5 while you're, let's say, fishing, or while you're riding on your motorcycle, or while you're watching a movie. So, if the price goes below 5, you will sell automatically. This will limit your loss to $2 on 7. Okay? That's about 28 whatever percent. Okay? So, this means you're not going to take any more than 28% loss. Okay? So, that's a simple stop loss. Let's see what else we got. Market. Market order simply means execute at the current bid or ask. Buy at the current bid, buy at the current ask, sell at the current bid. Market means it will execute immediately at whatever the market is at the moment. Okay? And sometimes you may have all or none. All or none will be associated with a limit order. Okay? You sell 500 shares at, let's say, $7. Okay? And they may sell 300 at 7. But the other 200 could be sold for $6.95. Okay. So, all or none means you either sell all 500 at 7 or you don't sell anything. Okay. So, these are all different variations. Every exchange will have some or most of these, and some will have certain types of orders, and other exchanges will not have different types of orders. Usually, every exchange will give you exactly which orders are allowed on the exchange, okay? They'll just tell you all orders which are available and what each order means. But it's usually these, okay? Let's see what else we got. So, I already spoke of the house. Number 1, order. I think it's 282. Let's make sure I got this right. Okay, order. It's 281. Is order. 282. Clearinghouse. The clearinghouse has the function to guarantee all trades, to be the counterparty of all trades, and to assume the counterparty risk and to guarantee it with its own capital. You guys can take a little picture of that guy there who's sleeping. You know? Yeah. Hello. We're still having class, you know? One of the primary functions of the clearinghouse is to require margin from its members. We say to post a margin. Margin is a requirement to put in certain amount of money, certain amount of capital to guarantee that a trade will go through. So, for example, I buy a stock option with a strike of 100, which cost 3, and he sold the option to me. In other words, I bought it from the clearinghouse, he sold it to the clearinghouse. Now stock goes up by $5, the option goes from 3 to 6. Now he owes 600. He got the 300, but now he's losing money. The clearinghouse will want him to post margin, meaning to give extra money to make sure that if I exercise my option that the clearinghouse will not lose money. So, margin is the requirement that the clearinghouse makes from members or traders who lose money on their trades. The margin is posted daily, which means that every day you lose money, every day you gotta pay more. This means that the clearinghouse minimizes its risk for up to a day. They say, give us extra 5,000. If you don't pay within 2 days, we liquidate your position. We sell your position at your loss. So, the margin is a tool that the clearinghouse manages its counterparty risk with all the other members. Okay? That's very important. So, let's do this. The clearinghouse is called OCC, Options Clearing Corporation. Options Clearing Corporation. So, when a position is losing money, the OCC will go and ask the money, meaning margin, from its member. You're losing 5,000, give us 5,000. That's from the member, okay? Now, the member will go to the broker, and the member says, hey broker, you got a customer who's 5,000 short. Give us 5,000. And the broker must pay to the member, no matter what, okay? Otherwise, the member will cut off the broker, okay? And the broker is going to lose business. Now, the broker isn't simply going to pay out of his pocket. The broker is going to go and ask it from the customer. So the OCC will say, member, give us 5,000. The member is going to say, broker, give us 5,000. The broker will say, customer, give us 1,000. If the customer, and they give the customer 2 days or 3 days or whatever, you know. And if the customer does not pay within 2 days, the broker says, sell. And this guy sells, and this guy sells, and everyone's happy. Except the customer, right? Who probably lost money. All right? So, the risk management goes by the chain. The OCC minimizes by spreading its risk to the members by requiring margin. Members reduce their risk by requiring margin from the brokers. And the brokers manage their risk by requiring margin from the customers. And if the OCC requires from the member 1,000 to make sure everything's okay, the member is going to require probably more, maybe 2,000, just to make sure he's safe. Well, if the member requires 2,000 out of the broker, what do you think the broker is going to say? Oh, broker, require 3,000 from the customer, okay? Just to make sure. So, OCC is protecting itself. This is protecting even bigger, and everybody gets a bigger protection along the way. So if the customer blows up, this one doesn't lose money. And if it doesn't lose money, this one doesn't lose money. The trick is not to lose money and to push the loss all the way to the customer. Okay. Next one is just a simple concept of open interest. Open interest is the total number of outstanding options. The total number of outstanding contracts. They may be 2,000, they may be 10,000, okay? As many. So this means the total number of long positions. And the total number of long positions always equals the total number of short positions. For every option in futures, the number of longs equals the number of shorts. And the number of longs we call open interest. I already explained 283 is called offsetting order. Is an order opposite of open position. If you own a long, an offsetting order is a short, and they cancel each other. If you have a short, you place offsetting order by buying long. The long will offset the short. And offsetting order, after it's executed, cancels the previous contract because they are both counterparty to the clearing house. This is very important risk reduction tool both for the customer and for the clearing house. This is also known as reversing trade. If you bought one, now you sell one. If you sold one, now you bought one. Reversing trade. Two, 8, 4. Exercise. exercising. Remember, I have an exercise price. How it's done? First, definition. European option is an option which can be exercised only on the day of expiration, okay? Only on expiry date. You cannot exercise early. American option you can exercise at any time before or on the expiration. You can exercise 2 days early or 5 days early. In other words, European option has no early exercise. The American option is anytime. When the customer exercises an option, they place, it's called exercise order. When they place an exercise order, the order goes against the clearinghouse. A clearinghouse will pick a member to exercise against. We call this assignment. Assignment. To assign means to choose a member to exercise an order. They may say, first order exercise or assignment are you. Second order, you. Third order, you. Fourth order. So they will have some specific rule. Doesn't matter, there's a rule, you can get assigned at any point in time. If you get assigned, you must deliver. You must, it's called perform. You must do your obligation. Okay? Sometimes you may have delivery. So you got 7 stock options. You deliver 700 contracts. Okay, so just say, hey, 700 contracts here. Okay, give me the money. Or you may have cash settlement. In a cash settlement, you pay the difference between the exercise price and the current price. Okay? So, the exercise price is 17, the current price is 20, you're losing 3, you're going to pay 300 per contract. You settle with cash. Okay? So, you give them the cash. If they want, they can buy the contract, they can buy the stock on the market. Okay? So, some contracts are settled by delivery and others are settled by cash. There is some tricky part about indices. For indices are for index options. Index options cannot be settled at the price of 11 o'clock or 1 o'clock. Index options, that's very tricky, very difficult, you can't really do, are always settled at end of day. We call it closing. Always settled at the index closing. And there's last concept called automatic exercise. To protect members, if an option is in the money at expiration, the exchange will automatically exercise it for the benefit of the member. So you got an option, it's in the money, it expires today, you forgot to exercise it, they will exercise it for you automatically. And then almost all brokers, if a customer, just a small guy like you and me, forgot about or didn't realize, thinking that expiration is on 22, but this month expiration is 15, so he didn't exercise, the broker will automatically exercise for the benefit of the customer. Okay, that's called automatic exercise. 9. Option pricing quotations. Very simple. You go to the exchanges, to the website of the exchange. You can also go to many brokers. You can also go to Yahoo. Quotation. Option quotation. You want to see what's Microsoft option with a strike price of, let's say, 200. So you want to see 200 July call, you go on Yahoo or you go wherever the exchange is, and you're going to get the price, sometimes with a delay. Nothing really interesting. 210. Types. Options. I already covered. Number 1, stock options and stock index options, already covered. Number 2, index options, already covered. Number 3, currency options, already covered. Commodity options, already covered. And bond or interest rate options, already covered. Okay? And I got very little, 2 sections, basically missing about 3 pages. You'll read on your own, not very important. 11 is costs. In general, options trading is relatively cheap. That's why it's so popular. The transaction cost is relatively low. There are floor trading fees, there are clearing fees, and there are commission fees. And finally, a standard cost is always the bid-ask spread. When you buy, when you sell, that's a cost of trading. And additional cost may be margins and taxes. Finally, section 12, we will not cover here. To 12 is regulation. Regulation is specific to the United States. You don't need to study US regulation. You need to learn the regulation on the market which you operate. If you operate in Hong Kong, you got to learn Hong Kong regulations. If you operate in Thailand, Thailand regulations. So, this section you don't need to prepare. Alright, thank you very much. Next time we continue with chapter 3.